finance agency. So I'm coming to you out of the Harrisburg area this morning. We're going to talk about the PENNVEST Homeowner Septic loan. That's a loan that PENNVEST is the conduit state agency for the funding. In other words, they bring those federal dollars back to Pennsylvania through the PENNVEST agency. And PHFA, my agency, is the administrator of the program. So we like to say that PENNVEST gave the most money, they gave all of it, so they get naming rights, just like a stadium. Okay, so the PENNVEST Homeowner Septic loan is a loan for either sellers or homeowners. We haven't found a way to make this program available to someone who's actually buying the house and realizes that the house has an issue. Unless they are doing, some kind of private financing where they can take possession of the home and they don't have to have a functioning sewer or septic system for 90 or 120 days or something like that. The typical government insured programs, FHA, RD, Fannie Mae, are not going to allow that, okay? It's a great loan, 1.75% interest up to a 20-year term, okay? That is one step off of free money, all right? You can take a 10, 15, or 20-year term for the loan. In other words, we can amortize it so you pay it back over 10 years, 15 years, 20 years. If it is a manufactured home, so manufactured versus stick-built, if it is a manufactured term, they are limited to a 15-year term. They can't spread it out to 20 years. Some of these weird quirks are not PHFA or PENNVEST's fault. They are actually the government insurance that we use through the federal government, and it's called Title I, FHA Title I insurance. That 15-year term distinguishing between a manufactured homes term for this loan and a stick-built homes term for this loan is their call. Yes, question?
When it says sellers and owners only, if a buyer buys it, now the owner, can they now take advantage of it?
If they can get into that home, become the owner of record, and then they can do that without a functioning septic or sewer system, yes. Now we're making a loan to an owner, that's fine. I get it that, they still think of themselves as the new buyer.
The reason I was asking, because I have a property in Bucks, and they're actually going to be putting in a public sewage line in about a year. So then I was wondering if that would
Yeah, something like that would work. What doesn't work is when they do the testing after the agreement of sale, and it fails the test, and then the buyer says, well, let me see if I can get this PENNVEST loan, but I'm getting an FHA loan or a Fannie Mae loan or whatever. That's what doesn't work, okay, doing those two loans simultaneously. Okay? All right. Okay, these loans can go up to $25,000. Again, that's our limit based on Title I, what we can get insured. The minimum loan amount that we'll do is $2,500. I have not seen anyone get out of the need to connect to public sewer or repair or replace their septic system for less than $2,500. So we haven't had to turn anyone away yet. Even in situations where maybe the construction costs are very low, the tap-in fee was over $5,000. And being here in the Reading area, you guys know the closer you are to Philadelphia, everything gets more expensive. In this area, the minimum is not going to be the issue. There will be folks who have to come up with out-of-pocket funds or other sources of funding beyond the $25,000 in this area. Okay. Now, that maximum and minimum loan amount is dependent on lien position. So if this loan can go into first or second lien position, we can lend up to $25,000. We can also do that if we're going into third lien position behind some type of 80-20 financing, or maybe the person is getting a first mortgage and then a second lien from a redevelopment authority or some kind of down payment and closing cost assistance through a government program, something like that. We can be in third lien position and lend up to $25,000 there as well. If we are going into third lien position because a homeowner has the loan that they bought their house with and also something like a HELOC or some other secondary loan, we will not be able to go into third lien behind that and lend anything more than $7,500. Okay? So a third lien loan for an existing homeowner is typically capped at $7,500. Okay? Does that make sense so far?
Mm-hmm.
All right. There's no CLTV, no LTV requirements on this program. We don't do appraisals. Now, it is a secured loan. Again, that's one of the things that my agency only does secured lending, but also we have this Title I requirement that these loans be secured above $7,500. So we take that for all loans. These loans do have about a 30 to 60 day ramp up period before closure. The construction work can be done very quickly, typically after that, as long as that homeowner is pretty high on the contractor's list. Obviously, availability of a contractor can impact how long it takes to get the work completed. But it does take about 30 to 60 days. We can do it in 30 if we have homeowners that just hand us what's needed, you know? Folks who seem to think it's an unbearable burden to provide us with 3 consecutive pay stubs can make this take longer than 60 days if they want to. Okay. So what can you do with this great, almost free loan? You can repair or replace your on-lot septic system, repair or replace an existing connection to public sewer, so that annoying situation where tree roots grow through the line that leads from the house out to the middle of the road. And we can also connect an existing home to public sewer. Now, by existing home, we're not talking about someone's going to bring a manufactured home onto that lot, secure it to the ground, make all the utility connections. That's new construction to us. Same with, new construction stick-built home. We cannot help in that situation. But if it's a home that, for example, public sewer came through 10 years ago, but you didn't have to connect immediately, you had to connect the next time that home sold. That's a situation where we might be able to make these loans. Or you have public sewers coming through, you have to connect right away. Sometimes it's, the other situation we've seen is it's optional whether you connect or not. And so when the family, 15 years ago had the option initially, they didn't choose to do it. But now that they're selling their home, they think that would be a marketing point. And so they want to connect to public sewer. Okay? Obviously, the point of the program, the reason why we make it available, is we're trying really to ensure that we have a good public health and safety plan as far as sewage management across the state. We definitely know that we are providing support to homeowners who are absolutely not expecting the costs that they're being quoted for this program. We also know that there's lots of folks on fixed incomes, whether they're buying the home or they've lived in it a long time and they need to sell it and they need to make these repairs and they can't handle that expense. But one of the biggest reasons why this program came into being in 1994 was because the state had allowed municipalities to let their sewage management plans get out of date. And when they started looking at this, and they, probably about 3 years ago, made a second deep dive into looking at it, there were lots of buildings in lots of communities that weren't part of the sewage management plan. In other words, presumably something appropriate was happening with the sewage that was coming out of that building or out of that house, but nobody knew for sure. It wasn't on the plan. So that's really the primary reason why the program funding was set aside. But we like to come out and talk to realtors, talk to associations of homeowners, talk to municipalities that are having a sewer expansion, or just doing what's called Act 537 planning, where they're reviewing on-lot in their community. We like to make sure that folks know what an asset this can be for homeowners. Almost free money, 1.75%, typically up to 20 years. Not a lot of worry about, or no worry about combined loan to value ratios or other valuations of the home, that kind of thing. Okay? So, now, go ahead, please.
One quick question. You said it was a secured loan.
Yes.
So if the seller borrows that money under those conditions to repair the septic system so that the property can go to settlement?
Yep.
Did that loan then get paid off at settlement?
Yes, the loan gets paid off at settlement. Right. We're we're not doing any assumption lending at this point where the buyer could assume the loan.
Okay.
Someday, maybe if we get enough volume in this program, but assumption lending has an expense for us that we aren't willing to bear at this point. But yeah, so the presumption is that the loan will be clear at the time of sale. Okay. Are there any other questions before we move on? I do want you to keep asking. Go ahead.
So the expense for the loan application fee, what, is there any fees?
Typically, the total cost for these loans is about $1,500 to $1,800 per loan. The borrower pays a share of that, PHFA pays a share of that, and PENNVEST pays a share of that. So the homeowner's out of pocket is typically no more, depending on the loan size they're getting, but it can be anywhere from a couple $100s to no more than $1,250. You pay basically a percentage of your loan amount. So the maximum it could be is $1,250 on a very small loan. No, I'm sorry, on a very large loan. But every homeowner, whether they make $35,000 a year, and we have had that family, $35,000 a month, and we have had that family, down to they make $1,000 a month. Every homeowner that comes through this program is actually getting a PHFA and a PENNVEST subsidy to help defray loan costs. Anyone else?
The Pacific is more obviously rather than Arthur.
Yes, in this area it's getting more and more expensive. What we require at that point is, let's say your homeowner goes out and they know they want to sell the house next year, they're going to do some various repairs to the house. One of them they realize is they have to install a new on-lot septic system, and they get a quote for $35,000. We can lend them $25,000. They need to, at the closing table, provide $10,000 to us to hold in an escrow, and then we disperse all of it so that there is record that everyone's been paid, that's all clear, there's no potential for mechanics liens, anything like that. And then the loan is cleared at the sale.
But they're putting out that.
Yes.
that
Yeah.
correct,
Yep. Go ahead.
Another question, you mentioned the manufactured homes that can't be put on a lot and then it's new construction and is there a time limit that maybe the buyer could own that lot, own that manufactured home and then come in and have one installed at
Yeah.
that time?
I'm glad you asked that question, because I do want to make that clear. If the manufactured home has been on that property and already has its utilities connected, and the homeowner says, I want to put in a new septic system, or I now need to connect to public sewer, that's our typical lending bread and butter situation. What we can't help with is they've owned the land in their family for 2 generations. They decide they're going to subdivide it, and each of their 3 kids is going to put a manufactured home on it.
Right.
But they're not going to connect it to public sewer, and they want to know how long they can wait until we'll help them. Unfortunately, that's not part of the mandate that we're allowed to do.
So there is no time limit on
Right,
that wait? It's just
right. It
no.
needs to be, you're repairing and replacing what already is in place, or because your area has developed and your sewer system is expanding, you need to connect from an existing home. Okay? And again, that's one of those quirks. I mean, maybe to you guys that seems like we're kind of slicing and dicing things in a sort of annoying way. I apologize for that. But the reason why is, again, what DEP is trying to accomplish, what they're mandated to accomplish with this source of funds, is to make sure that existing residential structures have a successful, fully operational sewage management system from that house. So it's not to help expand a community into new area, new land. Yes?
So all the lenders are going to be able to use these programs, or?
No, we have about a half a dozen lenders. In this area, the statewide lender is American Bank. That's a little bit further on in my presentation, so I'll make sure to highlight that when we get there.
I'll wait.
But in this no, that's fine. In this area, there is one lender that's working with us. If anyone, you all have my business card. If you don't, they're back on that back table by the door. Please take one. If you know of really community-minded lenders, especially the smaller lenders or credit unions in this area, that might be willing to partner with us, we're always willing to go out and talk to them about joining the program. You know, they are compensated for making these loans, everything else, so it can be a good win-win. Now, it's not typically for something like a Wells Fargo or a Santander where they have to get approval from Texas, and then they do underwriting in Rhode Island, and they do closing packages out of Minnesota. That kind of situation typically doesn't work. But a local, very community-minded or lending institution is a great partner for this program. So I'd be glad to hear about any of those. Okay. So the next two slides might seem, if this hasn't already been a little painful, I mean, we're talking about sewage over your lunch. And
They knew that coming in.
And we're talking, what's up?
They knew that coming in.
Yeah, you knew that coming in. I mean, there's nothing hidden in the name of the program. But we've also been talking a lot about loan details, which may not be your favorite part of selling homes. But at this point, I want to get into some of the questions. Sort of the next two slides are sort of a frequently asked questions section, just to make sure that you're not thinking of a homeowner that, wow, this program would be great for them. This will set them on the glide path to being able to sell their house. And there's something in the program, typically a Title I requirement, but not always, that just is going to preclude them taking advantage of the program. So I'm going to take a slightly deeper dive into the nitty-gritty, and then I promise we'll come back out of it and start applying the loan to your scenarios, your sales scenarios. Okay. So the program is only for your primary residence. So let's say you're a really generous dad and you have a young family, daughter, son, whatever, and they need a little bit of help connecting to public sewer. We can't lend to you for the work to be done on their house. We can lend to you for the work to be done on your house. Okay? And it has to be your primary residence. It can't be, the commercial building that you have down the road or anything like that. This is a residential program. If you're aware of a business owner who needs to look into commercial financing that isn't private financing, the PENNVEST Authority itself may be able to help them. And their phone number, their toll-free number is on the last page of this presentation. But the program I'm talking to you about today is specifically for your primary residence as a homeowner, and the system that it has to either connect to or have operational. Homeowners are defined as people who own 50% of a house. This is one of those unfortunate things that if the feds would update this program's requirements, we'd be in a little bit better of a situation. So the expected borrower in this program is a single homeowner, a husband and wife. It can certainly be a husband, wife, and an adult child, as long as their deed is written that they succeed each other. So it's really two 50% ownership interests. The child and the husband and wife are each considered one. The deed has to be written appropriately for that. Where we can get into a sticky wicket is if 5 adult siblings inherit the home and they're all on the deed. 3 of them are going to have to come off for this loan to be made. And one of them, who stays on the deed, is going to have to be living in the house. Okay, we do run into that. We do run into inherited houses. You can typically pay for, if everybody's very amicable to this and 3 siblings say, hey, we'll work out the finances later, but yes, I'll get off so that we can get this house fixed. We can even allow the financing of the quitclaim deeds and that kind of thing through the program, but we do have to meet those criteria, okay? So when I talk about this as a loan for homeowners who may be selling or homeowners who may not be, the applicants do need to have a 50% ownership interest in the home, and it needs to be their primary residence. The floodplain requirements that we have are a little bit restrictive. If no part of the house is in an A or a B floodplain, we're golden. Everything's good. We can do these loans. If a portion of the house is in that, even if the homeowner has federal flood insurance, we are not allowed to let. Okay? About 3-4 of these a year tops. Do we get a question about that? And I don't blame these folks. They're frustrated because here year they've been able to go out and get flood insurance for the property, but we still can't lend to them to connect to public sewer. Go ahead.
Just so I'm clear on it,
Yep.
because you said the house, but that says the septic system in the flood zone. So I just want to make sure that
The house and its septic system
Okay.
have to be out. What can be in is the corner of the garage, the corner of the deck. We're okay with that. What we can't have, and we try to be as generous as we can at PHFA, we've even, looked at what part of the septic system is in the flood zone. Now, if it's your drainage field, or if it's your holding tank or something like that, we can't do it. But we have had some situations where it was one
lateral
of the
running
systems
through
has a
the.
margin around your floodplain. That was fine, we could do that, because it's really a buffer zone at the end of your drainage field. So we will look at those situations, but we do have restrictions that are a little bit more restrictive than what folks are thinking of when they say, well, I have flood insurance, and that's an FHA, and I have an FHA loan, and then this is an FHA insured product, and they think, well, those must play nicely together. Unfortunately, they don't. We are required to be a little bit more restrictive. The last part of that is that scenario I was giving you where a corner of the deck or a corner of the detached garage is in the flood zone. They will have to maintain flood insurance during the life of this loan. They'll have to get it and they'll have to keep it while they're paying this loan off. And that's if only those sort of extraneous areas of the property are in the flood zone.
So the bottom end of the field,
Yep.
no, who cares, you don't care.
Yep. 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 What's especially nice is a lot of times in that scenario, folks are connecting to public sewer where they used to have a septic system. And so we're actually even getting their whole sewage management equipment away from, the back end of the property that rolls down to the stream, that kind of thing.
So you're saying even if you're connecting to public sewer and it's in the flood zone, they still won't know?
Right.
Oh,
Right, if any part of the house or the system itself.
gotcha.
Yeah. And you can always, this is one of those things, if you think of this program 3 years from now and you have a seller who, a portion of their property is in the flood zone, bring it to us as a question. You'll have my contact information, ask us. I'm hoping to be able to chip away at this and update this program. And I'm also hoping that, one of the best things we could do, for example, is stop worrying about whether the pipe from your house to the sewer main is in that flood zone.
Yeah,
Right.
yeah.
Much better that than their whole septic system
Yep.
is in the flood zone. So, like I said, I am hoping to chip away at this. We may be able to update this. Okay. Another question that we get asked is, okay, you don't have any loan to value, you must have some kind of restrictions on this loan program. We do. Our primary one is a debt to income ratio. Best bet is 45% debt to income or less. We can go up to 47% with some kind of compensatory factors. A compensatory factor is something like there's a spouse that isn't going on the loan, but they're also employed. The homeowner has significant assets that they're willing to disclose to us. The homeowner has a second job, they didn't want to use that income, or they have alimony, they didn't want to use that income for the loan application, but those things exist. Okay? Sometimes even things like car allowances or housing allowances, travel allowances that they get on a routine basis that we can document, enable us to go up to this 47% debt to income.
If this loan is used by the seller to comply with having to repay his emergency septic system so he can go to settlement, that's gonna be a short-term loan for a bank. Is there a
No, there's no,
prepayment penalty or?
no
How can they make
prepayment
any money
penalty,
if it's not
nope.
Just on that $1,800?
I'm sorry, say that again?
How does the bank make any money? Just on those upfront fees if it gets paid off? Like
If they pay it off really short term, we don't make money.
Wow.
The majority of borrowers in this program are homeowners who are planning to remain in the house. But I wanted to make it clear, obviously for this audience, that that doesn't have the only type of loan we're making.
It's a great program for us when we deal with those situations. Not a lot of people have that kind of money to just put
Correct.
a new septic system in while they're waiting to go to settlement.
Yeah.
It's awesome.
Yeah. And, you know, one of the things that we'd really like to encourage, and I'm sure you would also, is that when someone starts thinking about selling their home, they're 62, they're gonna move to the coastal house, the warmer weather house, whatever it might be, or just, you know, across town, closer to the
Smaller,
grandkids.
yeah, downtown.
Start thinking ahead about what it takes to sell your home, and look at your septic system, or, you know, or be prepared. Typically, when a sewer system expands to a new part of a community, it typically takes about 20 years to go from, you know, initial discussion, and then everybody sort of says, oh my God, don't even think about it. And then there's another phase where they do some feasibility testing, and then they do more feasibility testing, and then there's usually a lawsuit, maybe 2 or 3 of those, you know. And then finally, 20 years later, everybody's mandated to connect to public sewer. And of course, everybody's hand goes up and says, how do you expect me to pay for that? I had no idea this was coming, you know. So that's the other thing that we're trying to do here, is help folks out of a situation that they were really praying was going to occur after their tenure in that home. And, you know, we all get stuck without a chair when we're playing musical chairs sometimes, right? So, yeah. Go ahead.
But if it's for the primary residence, and she was saying about to sell, I have one now that they told me it's gonna take 4 to 6 months to hook
put
up
in-
to public sewer. So you
Okay.
really couldn't do it for when you're gonna sell unless they knew it
Right.
way
So,
ahead of time.
in this situation, unless the buyer and the seller can agree that the seller's gonna remain in possession of that home until that system is fully installed,
Mm-hmm.
yeah, and, you know, you may or may not have a buyer willing to wait for that.
Okay.
It's kind of funny that you would bring that up. We actually had that scenario last year, and I was incredibly sympathetic to the guy, but these phone calls were so stressful to me since I could do nothing about it. He was in the Montgomery County area on property that just did not drain well. So they were putting in one of these systems that's appropriate to that kind of soil, and he would call me every week to tell me whether it was predicted to rain or not. And after a while, I started feeling stressed out about rain in Montgomery County, and I kept thinking, I live in Montgomery County, I don't work in Montgomery County, keep breathing, it's okay, you know. But yeah, I mean, the gentleman and his buyer had a more extensive relationship than they had any intention of having. It did all come together and it all worked out. You know, 3 days later, the loan was paid off and everything else, but yeah. But we're not, I mean, obviously, PHFA and PENNVEST would have, you know, we do have to at least recoup what we put in this program plus 1%, that's our federal mandate, but we don't have to make the typical margin to pay for, you know, salaries and that kind of thing. We are actually, PHFA is a bond-funded agency, so my salary comes out of that rather than out of this program. Trust me, I'd be taking a second sandwich if it came out of this program. One second, I had a question over here.
For the compensating factors, you
Yeah.
said that a second job could be counted. Do you have to be in that second job for over 2 years? Or is there a time limit that you need to be in that?
We would not require 2 years, we'd be looking for at least a year. 2 years is obviously better, but we would look at least a year. And, you know, could we get a VOE on that second, a verification of employment on that second position? That kind of thing, yeah. Okay, sorry.
I was just thinking about the buyer again, that we're leaving the buyer out of this scenario, and we're trying to think of ways that the buyer can do the scenario. But if there's, is there any kind of situation where it could be an escrowed amount on this loan, so that, you know, the seller could escrow the money from settlement or something like that, and then it would benefit the borrower? It just has to be done ahead of time. Do you know what I'm saying?
Yeah, we would not be allowed to fund an escrow that was held.
Okay.
I mean, that's sort of our problem, is that this program is our best ability to take advantage of every inch we have with Clean Water Act requirements, FHA requirements, FHA Title I requirements, which are not as modernized as the purchase money program is, which is Title II, you know, PHFA and PENNVEST requirements because of our legislation. So, yeah, that scenario. What would work is a buyer who either, the buyer and seller agree to go on a monthly pumping schedule, and then once that buyer buys the house and becomes the owner, then they could turn around and apply for this loan program. That's one scenario that works. That's expensive though. I mean, that's, probably $400 a month typically. Not a lot of people are gonna wanna do that.
I was just saying that the primary lender for the buyer probably wouldn't go along with that.
Well, yeah, I mean, it depends on what type of loan they're getting, absolutely, yep. The second thing that can happen is if they are getting some kind of local lender, portfolio loan, in other words, it's not a government insured or financed
Right.
loan, yeah,
Private lender.
yeah.
Right.
And again, that's
So awesome.
definitely not the main method of how we all buy houses.
Right.
Yeah, go ahead.
So, you were talking about different types of systems and that sort of thing. Is
Yeah.
there any restrictions or limitations to the type of septic system that this is applied for, or is it subject to SEO approval of a specific type of system?
It does have to be something that the SEO will approve. So I can't even name something that's
Like peat moss
truly
system or something
exotic.
like
Well, I
that?
mean, that stuff, the state of Pennsylvania has approved systems, and we have
Alternate
experimental
systems,
systems
yeah.
and alternative systems, but both of those can be approved.
How
One of
about
them
holding
is-
tanks?
We will not finance a holding tank forever. That can be an interim part of the solution, but no, we wouldn't finance
Because
that.
there are some properties where the municipality does not have public sewer available,
Right.
and they're antiquated cesspool systems. And
Yeah,
if
they
they
don't have the
fail,
lot
then they have to
size
go
and
with
everything else, yeah.
because they don't have the space available
Yeah.
for a drain field.
Yeah.
So,
The answer was
So you're
yes.
saying
but
The
no.
answer would be no, we wouldn't do a holding tank.
No.
What typically would be looked for in that situation would be something that the borrower would be refusing. Now, I can't say this is true in every situation, but what typically happens is the scenario you were laying out, the homeowner is presented with a ghastly expensive, on-lot processing system, and there's a better
Right.
name for it, but they're frighteningly expensive. In this area, they could be $50,000 to $70,000. And the homeowner says, no, I'd rather pump, because it'll be months and months, years and years before I start spending that kind of money.
right.
Okay? The holding tank in this scenario is seen as a temporary solution. We wouldn't be able to fund that. But the on-lot processing system, it's actually kind of like a mini sewage plant being installed on your property. That we could finance if they chose to do that.
Okay.
Luckily, we don't have too much of it,
Yeah.
Well, that's exactly the scenario I have in the house that I have.
Don't we
Well,
all?
for the program, I know you say you can't, but the betterment is for the quality of the water and for the citizens. And so if your only option is, not because you want to lessen your expenses, but your only option is a holding tank.
Correct.
You exhausted all other avenues of that, and you got a holding tank. Whether you like it or not, you got a holding, or you can illegally continue to pump your sewage into the local creek. So,
But the problem that we have is we have to prove to the providers of the Clean Water Act funding, both at the federal and the state level, that the solution that that homeowner is implementing will be faithfully implemented so that it is a permanent and effective solution.
well, and that's a.
Every homeowner that quits pumping has just broken the chain of that house having effective
Oh, in
sewage
this
containment.
scenario, the township actually set up an escrow for money there, so if they did quit, township would step in with their money, with the homeowner's
Yeah.
money.
Yeah.
So I know it's kind of real rare oddity, but there are circumstances where
Yeah.
they're backed up against the wall.
And you would find them.
And
I
that's the
don't
only
mind
option.
at all if when you come to that situation, if you want to, that situation with a few wrinkles, that situation exactly, I've already tried, I know I can't do that. I
Right.
can't permanently finance holding tanks. But if there were an issue of, it's going to be a holding tank because of that exact scenario, until they get the sewer expansion done. And the sewer expansion is only being held up by one lawsuit at this point. I'd be willing to give something like that a try, because the permanent solution is in sight. And we would be financing, it would have to be with the agreement of the homeowner that we would be financing their connection to public sewer when they can make it. I'm already starting to hear the conversations I have to have, I'm not sure we can get there.
No,
But it'd be that would be worth trying. But the holding tank in perpetuity forever and ever, I can't get that. We've already tried
I
that one.
understand the
Yeah.
red tape you have to run through, but on the other side of the fence,
Yeah.
there are properties that exist that need
Right.
help.
Yeah.
And
Yeah.
usually the help comes in the middle of the night with a little backhoe, and they just dig their own sewer system because they illegally. So these people are legitimately stuck in a holding tank situation, and there's no other hope. So that's why I ask
Yeah.
and push on that.
Definitely something I'll take back. Don't look for that change in the next 18 months, but we'll work on it. We'll work on it. Okay. What other questions do we have right at this point?
Question.
Yes, go ahead.
I've seen municipalities provide this type of loan kind of through like their redevelopment authorities. Are they also funding through PENNVEST?
They may not be. They may be funding through bond funding or other local funds they have available to them. And this area, you're right. The further southeast you go, the more capacity and sophistication the municipal managers have. So you may be more likely to be able to sort of assess, all right, what makes the most sense for me is, John Doe homeowner. My local municipal authorities program, the PENNVEST program. In most of the rest of the state, there aren't municipal programs.
Okay.
So that's why, when we look at the program as a statewide program, we're doing niche lending that, we can make a great rate available, we can bring in financing that a lot of homeowners are not gonna be able to access.
Okay.
But you are right, in this area, you may have alternatives, and certainly, as realtors, we would encourage you to tell the homeowners, look for this program, figure it out, what makes the most sense for your particular situation. Okay. One of the questions we get about lien position is, I've been in my house for 10 years, I have a first mortgage, and I have a home equity loan. That would put the PENNVEST loan in third lien position. But I don't have any balance on my home equity loan, is that okay? No, you still have a loan in second position that we would actually ask you to close. And when they say that, that's not fair, I don't wanna do that, I like having that home equity loan. Okay, but what is the rate on your home equity loan? Do you wanna use it to finance your sewage management system? Or would you like to borrow up to $25,000 through this? Now that's not, the nasty talk is not something you guys have to do, but that's what I'm gonna say. If they call in to ask, do I really have to close my home equity loan? Yes, you would. Now, I'm not gonna monitor whether, if you can find someone that will lend you a home equity loan in third lien position, go for it. You have found a gem of a lender, because that's not real common. But if you can find one, or if you can find one that will subordinate to this PENNVEST financing, that works too. We do make direct payments to any vendor that the homeowner owes money to. So the homeowner might owe the municipality a tap-in fee. They might owe Smith Excavating for their excavation costs. They may owe an electrician some money to cover an upgraded electrical panel to run their grinder pump, whatever it might be. PHFA pays those directly. The homeowner does not actually take possession of the funds. Okay?
What's the time frame for that generally?
We can typically, from the time the homeowner approves the payment, we typically have a payment out within a week. Yep. Probably our biggest issue is homeowners who say to us, well, I thought you knew they were done and that you'd pay them. I do not have the ability to see from Harrisburg that your job has been completed in Reading. So yeah, but as long as they tell us, it moves very quickly. I've talked about application timeframes. Again, that can be another issue for homeowners who, in the middle of a sales process, realize they have a failed septic system. It's unfortunate, but we are not able to do unsecured financing. again, that might be the kind of situation where even though it isn't as cost effective, you may want to go with a local municipal authority solution, just because it's gonna be short-term borrowing. We typically look at, and I wanna assure you, this is something that we've almost completely flown through. When this program was developed, we looked at 10-acre lots as a limit. We very quickly realized that there's lots of communities in Pennsylvania where 10 acres is a typical lot size. It's residential, it's not a small farm. We don't worry too much about lot size. We will note it, however, and we will ask, is this land being used for farming or agriculture in any way? But we typically can go above a 10-acre lot. Okay. And again, we make exceptions wherever we can in this program. So if I haven't hit on the unique situation of a particular home seller that you're working with, or a particular house that you're aware of, feel free to give me a call. I mean, I'm not going to make a determination right here, standing here on the fly, but give me a call back at the office, and we can certainly discuss that further. Okay. So what does it cost to borrow $15,000 or $25,000 at one point? Go ahead.
I just have a question regarding
Yeah.
the lot sizes.
Uh-huh.
So why is it that someone who owns a farm that has 40 acres, but they live there, and they need a septic system, why doesn't this program work for them?
Because if we had to foreclose on them, then we have to sell a farm. And the agency doesn't do that. We encourage them to work with an ag lender, because that lender has that comfort level if they do have to take foreclosure or other type actions where they're going to end up owning the farm. Again, that is an area where we have been able to make some inroads. I know we've worked with a 30-acre property, and then they parceled the land around their house off. We were able to work with that. But yeah, the typical working farm where they need a septic system, the primary thought is, because we have to think that way, what if we had to foreclose and now we own a farm? But the secondary issue can also be, once they've gotten approval to hook up their house, then they want to hook up, the outbuilding bathrooms that the employees use, the kitchen that's in the, another part of it. They have to do something with their dairy barns, and that impacts this. So, yeah. But again, that's an area where it's a good idea to bring us a scenario, and we'll see if we can work with them to come up with a solution. Okay? All right. So what does it look like to get 1.75% interest money for a $15,000 loan? It's about $75 a month for 20 years, and it's just under $124 a month if you need to borrow $25,000. So for that homeowner or new buyer, this is a way to make something that is pretty darn expensive, pretty affordable over 20 years. Okay? And it certainly avoids citations and other issues that can be very difficult to deal with. I mean, we're actually working with a community out in western PA where the municipality has put liens against the properties of folks who missed their deadline to connect to public sewer. And, now they've got that added complication that they run the risk of their first mortgage foreclosure accelerating that loan. They're certainly in a challenging position for selling that home. So, and just so you know, I mean, that's actually an issue where we came up with a policy to work with them to help them remediate their septic situation and connect to public sewer so that they can get rid of the lien for failing to do so in the first place. Stay with me here, it's complicated. And then, ultimately, whether they continue to live in their house or sell it or whatever. Yeah. Okay. All right. Everybody got a brochure? I'd be perfectly willing to give you more. Reach out to us. Oh, wow, that was, go ahead, here first.
Okay. You use this program,
Yes.
you're ready to sell your house, but you don't have enough equity to pay off that loan. What happens?
Well,
I mean, since you weren't qualifying and
It's a very sad situation. We encourage your realtor to work harder. No, I'm kidding. No, what we would be doing is, as we would with any mortgage loan, we'd be looking at, okay, what are our options here? Does it make sense as an agency to accept a short sale? Does it make sense to, try and foreclose on the property and see if something else can happen? I mean, I'll be honest with you, we are not promising that we are going to tell homeowners, okay, we'll write it off, but it has happened after everything else has been looked at, because obviously our first responsibility is to at least make 5% on this portfolio of loans, so we can't be letting everybody walk away. But we're gonna look at all the typical lending scenarios, and then when they don't work out, we're a state agency. It's not our responsibility to get money back at the detriment of a Pennsylvania resident's ability to continue living, breathing,
Just wondering.
functioning. Yeah. But the first thing we're gonna say is, who's your realtor? Get one from the Reading-Berks Association.
There you go.
Yeah.
I have one question. I'm trying to think outside the box here. That's what I do, right?
Okay.
So the seller has a faulty septic system. They're under contract. The seller doesn't have enough equity or says, I can't do this. This is too scary for me. And the lender says, you have to have a new septic system to go forward with the mortgage. Have you ever had a situation where the lender would allow the buyer to put that system in with the buyer borrowing the money after settlement because the $75 he can qualify for that? Have you ever had a lender say, yeah, we'll make your agreement contingent on you being able to do this after you own it? 'Cause
Yes, but what they did is they switched them out of a Fannie Mae, FHA, USDA, VA type loan into the lender's own portfolio loan, and they agreed to that scenario.
Okay, so it could be done.
But, I mean, not every lender has a portfolio product. Not every lender's gonna have an appetite to do that.
Right.
But if we have had maybe one that I'm aware of, yeah.
So this loan is for the installation of the septic system, period. Is there any monies that can be had for the preliminary inspections to do the perks and probes?
I'm so glad you asked that question.
Okay.
Yes. Now, there can be one of two things happening. Obviously, if it's preliminary testing to confirm that your system has failed, and you haven't even made a loan application yet, you as the homeowner are going to have to pay for that up front. Hang on to your receipts though, because we can then reimburse you for those types of costs once the loan is in place.
So what I was talking about is at that, and you have to get a contractor out there to dig the hole, the SEO has to stick his head in again. There's costs in that.
Yep.
That can add up to a few $1,000s,
Yep.
so that could get rolled into
The loan that ultimately gets made, yes.
Okay, all right.
As long as, the way we word it to homeowners who ask us about that situation is, do the testing that you have to do to determine that you have to have a new system or connect to public sewer. And then, don't do any part of financing or implementing the solution, i.e. don't start digging for the new septic system. Stop and get this loan closed, and then move forward.
Right, a lot of times that the system's determined that it's malfunctioning, which
Yeah.
cannot improve it, or
Yeah.
fix and repair it, or
Yeah.
improve on it.
Yeah,
So then you go to the next phase where you have to find another site for another system.
right,
Start,
Call you.
yeah.
okay,
Stop and get that loan in place.
all right, got it.
And, and a lot of people say, well, I didn't want to do that. My contractor was right there. I wanted them to keep digging.
Right.
Okay, but then that's,
That's on
you
you.
have to finance
It's on
it
you,
now.
yeah.
We have to actually have our loan closed before you start the solution. In other words, before you start putting in the new septic system.
Mhm.
One of the nice things, though, to add on to this, since it hasn't come up, is while we cannot just finance a new well, in the scenario that you're giving us where the septic system has failed and has to be moved to another part of the lot,
Mhm.
they may have to now move their well
Mhm.
because there's 100-foot separation.
Right, yeah.
We can pay to move the well in that scenario.
So all of that, is that in addition to or subject to the $25,000
All
cap?
of that is subject to the $25,000.
Okay, so-
I know we're not helping you pay for all of it, but we're helping you
Right.
have less expenses
Yep.
paying for this. You are still going to have to come up with out-of-pocket funding or another financing source, you know, that kind of thing.
Absolutely.
I do, I mean, not to brag, but I have one person at HUD who will listen to me, and I do tell them, you guys really have to raise this program up to $50,000. PHFA and PENNVEST are one of the largest lenders in this program. We've only done about 110 loans last year in this program. But we are one of the largest lenders in Pennsylvania. This program is not highly used across the country or in Pennsylvania. Most companies would prefer to just do a HELOC loan, not worry about it being insured, that kind of thing. But I have actually been pushing that issue of these loans have been $25,000 loans since the 1980s when the federal government came out with a program. I believe it was the 80s. Let's go, come on, double it. So at least one person at HUD says, you're absolutely right. I probably only have a couple hundred more that I have to find out who they are, talk to them, convince them, but I've got one person, you know, and hopefully she's talking to people. But yeah, so at this point, we are still at 25,000.
Is there a limit to the size of the fund that you're available to utilize
I mean-
over the course of a year? Like similar to USEA running out of
Right.
funds
No, we don't
for
run out
rural
of funds.
housing?
We don't run out of funds, we don't close this program when the state doesn't have a budget. Yeah, I mean, the program stays operational. I'll still be at my desk when the state doesn't have a budget. That's one of the joys of being bond funded. Your paycheck keeps coming, which is a good thing, but you also still come to work. So, yeah. All right, I'm Roberta Schwalm, my chief officer, Marissa Burrell. You have our contact information. At the bottom, you also have the PENNVEST Authority's contact information. They would be the right folks to call if you think Marissa or I are terrible. We also have two other staff people within the company. But if we did something to your homeowner that you just felt was, this can't be right, or this is unconscionable, or whatever, your complaint outlet is PENNVEST. You also have the ability, if you have someone, you know, maybe you're working with them to sell their house, but they have a smaller mid-sized construction business or other business, and they need to find some type of clean water financing for that. Maybe they have stormwater issues on their property. Maybe they have sewage issues from their commercial building, that kind of thing. The PENNVEST Authority may be the right folks for them to talk to.